For mini multi, it hasn't been reached as much. And so these people are very happy to get in touch with us. We buy at what we think is, 30 to 40% discount versus what that property might be on the market for if there was a broker process and they added some value in some key places before selling. And so it's really a win-win-win situation. We save them a broker fee, we get an excellent deal, and the neighborhood in the city where this forgotten about property that has vacancy or maybe doesn't look as good as the neighboring properties, it gets restored to its glory. So it's really everybody in the process is a winner at the end.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Ray Heimann is a multifamily investor focused on institutionalizing the lower middle market and bringing mini-multi returns to investors. Ray, welcome to the show.
Thanks for having me, Sam. Great content on this podcast. I've actually stolen a couple tidbits, so excited to be a part of it.
Absolutely. The pleasure is mine. It's guests like you that make it go round. Ray, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Yeah. So I grew up in Cleveland. I'm a Midwesterner. Super hardworking parents, both own their own businesses, one of which is a architecture and construction firm, which is what sparked my interest in real estate in the first place. But I shipped off to New York for college at Columbia. That's where I met my absolutely stellar business partner, Tom Higgins, who's a developer by trade. And that's also where I started buying real estate for the first time. So while we were still in school, we were buying small multifamily properties in New York City, a couple 2-unit, a couple 3 units here and there. And that's also, sort of what opened our eyes to the opportunity in mini multifamily or smaller multifamily properties. And I also had some pretty serious jobs after school. I worked at JP Morgan in investment banking, covering US REITs. I was at Booz & Co., where I worked on their acquisition strategy desk. And finally, I worked at Terra Capital, which is a private equity fund doing healthcare and real estate. But we kept buying small multifamily properties in New York. At some point on the line, we looked up and said, hey, we're getting pretty good at this. How can we really turbocharge it and make something big out of it? And so we did, and happy to dive into our model and what we do. But that's pretty much what brought me here today.
Man, I love it. And I love just the consistency of finding one thing and sticking with it until you've really perfected it. Before we hear more the pros of your strategy, maybe tell us some of the cons, like small multifamily. We obviously get a lot of people that come on the show. They'll be like, hey, go 200 units and up or 100 units and up, whatever. They tend to argue, or it has been argued, there's economies of scale. The bigger you go, it seems that you've been able to find a way to have economies of scale the smaller you go. How do you do that, and what are some of the challenges you face?
Yeah. So, before getting into the cons, maybe I could give an overview of exactly what it is that we do, because I think that would help help frame that a bit. But we are a value-add multifamily real estate fund, but we're focused in the lower middle market. And specifically, that means we're going after 2 to 15 unit buildings. So really the smallest apartment buildings out there. And we buy anywhere from 15 to 20 units worth of these types of properties each month. So there are a lot of closings, anywhere from 1 to 5 each month. Some people call this the mini multi space. We like to think of it as the part of the market that's too big for flippers and too small for developers. And if you think about that for a second, that gives us a huge competitive advantage, because most of the folks that are out there just aren't the right size to take it down. It's either way too small for them or way too big. It's too much for them to bite off. And we do a tremendous amount of value add. We do a bunch of renovations in each of our units. 20 to 50% of the total dollars that we spend on a deal are in renovations. And what we're focused on is buying a lot of these properties, aggregating them into 150 unit plus portfolios. So to your point on asset size and at scale, we sort of mimic that asset class and create that out of mini multi properties. But the con, which is very obvious here, is that closing a 150 unit property and closing on a 5-unit property are actually pretty similar. It's a similar amount of effort that goes into it. The due diligence, obviously there's more units, but because they're very similar to each other, it's a lot of the same work that you have to do. You have to go to the closing agent. I was just, before we started, talking about having to do a notary right now. It's an annoying process. So The biggest con is that there's a lot of headache and process involved in closing that many properties a month. And a lot of what we're focused on is all the way from the front of the funnel, obviously getting in touch with sellers. We do about 70% off market today, all the way through to the process of closing those deals in as systematized and scalable a way as possible. And that's really our differentiating factor. There's a lot of similarities between how we operate and what we do and a single fam aggregator. And so, we've brought a lot of that model to the mini multi space, but it's a headache and it's brain damage for returns in a lot of ways. So we systematize that out as much as we can.
Brain damage for returns. Let's talk about that for a second. I would imagine if you are, as you put it, too big for a flipper and too small for, your institutional buyers, when you're buying them one at a time, that you do get maybe risk adjustments. You get more favorable, even think more favorable returns on an asset like this because of the way you're buying.
We do. And the way we buy them, the way we renovate them, the way we manage them, and the way we sell them, all four of those things, build into our returns, which 2.1 to 2.4x net return on capital for investors, 23 to 28% net IRR for investors, versus, knock 8-10 points off that for something as a, larger scale multifam. But we're buying off market, truly off market, getting direct to sellers. We are renovating at scale and getting economies of scale out of having a lot of units going at the same time. So instead of one project with one large contractor, we'll have 30 projects going on with 2 or 3 small to medium-sized contractors. And then we manage everything in-house for cash flow. And then when we sell as a portfolio, we sell for a lot more per unit than we would be able to sell on a one-by-one basis. So really all four of those things build up into our returns. And we try to take advantage of all four as much as we can. But each of those in and of themselves is a process and something to systematize.
Oh man, it sounds like it. And I want to hear more about those systems, because I can only imagine the number of moving parts inside of this can probably at times be staggering. It's staggering to me just listening to it from the outside. What'd you say, like 7-10 closings a month or 5 closings a month? It's something like that. It's a lot of moving pieces. On the acquisition side of things, are a lot of these, because of the size of them, just legacy owners that you're buying from, that have just kind of milked it for all it's worth, and now they just need to get rid of it?
Nail on the head. A lot of the sellers that we talk to are people that are just worn out by the process of managing a property. It's not their calling. It's not what they're good at. They might own 2 or 3 multifamily properties total, but usually just one. Frequently, they inherited it and either forgot about it or have no idea what to do with it. Right. And so we reach out to these people. We get in touch with them. It's sort of a big data problem, getting the properties that we want to go after and the contact information and all that. But we've pretty much automated the outreach through email providers, cold calling, third parties, et cetera. And when we get in touch with them, we are frequently the only people that have reached out to them, which might be surprising. For single family homes, it's not true, right? Anybody who owns a single family home has got a mailbox filled with mailers, right? But for mini multi, it hasn't been reached as much. And so these people are very happy to get in touch with us. We buy at what we think is, 30 to 40% discount versus what that property might be on the market for if there was a broker process and they added some value in some key places before selling. And so it's really a win-win-win situation. We save them a broker fee, we get an excellent deal, and the neighborhood in the city where this forgotten about property that has vacancy or maybe doesn't look as good as the neighboring properties, it gets restored to its glory. So it's really everybody in the process is a winner at the end.
That's cool. Yeah, I was going to say, it sounds like you said you're spending 40 to 50% of the total, project cost on renovation. So it sounds like you're bringing a pretty outstanding product.
We like to think so, but what we're focused on is, my partner, Tom Higgins, he is a developer in his background, and that is really our renovation and finishes focused is based off of those best in class national developer grade finishes for luxury. And so what we're providing is a small multifamily version of a luxury buildings, the same, subway tile finishes, new bathroom, kitchen countertops, washer dryer in unit, engineered hardwood flooring, the list goes on. There's no common space amenities. There's no gym or anything like that, but it's a 30 to 40% discount in rent versus what the large scale multifamily luxury property is down the road. So we always like to picture ourselves as we're the 6 to 8 unit building that's maybe 3 blocks from the new development building. Looks similar on the inside, but has a little bit more character to it and is significantly less expensive for the upper echelon piece of workforce housing.
Right. I have in my head when you describe what you're buying, like I'm thinking like downtown Indianapolis, maybe something that's like built in the anywhere from the 30s to the 60s. That's a really cool vintage building, a 12 unit building that has just not been loved in a long time. That's what you're buying. Brick exterior, character to the building, cool entrance, but just need somebody to kind of buy the place. Is that the kind of type of building that you're actually buying, or am I missing the mark?
That's exactly it. And there's usually a cool historical component to the building or the facade, whether it's something over the entrance that says Columbia Building or something like that, whatever. It looks cool. It is attractive to renters, and it's a fun thing to restore and be a part of the restoration process. And we are operating in the Midwest, and happy to talk about where we do that and why we do that. But every single city, every single market in the US has these properties in them. And it's a major service to the community to bring it back up to where it was before. And we are passionate about being part of that process. We're returns first for sure, but there's a mission component to it as well.
No, I love that. When having worked in some of those buildings in a previous life, there was always that budget component where it was like, okay, so we think it's going to cost $100,000. And then by the end of it, we just figured out that you just took your budget and basically doubled it for some of those older buildings. I'm taking some licks on that front and now perfected the model, or what do you guys do on that front? Because I know some of these historical buildings, not until you uncover something, you go, oh, wait, this is 50 years of poor construct patchwork that we've got to fix. How do you overcome that?
The simple answer to that is what you already said, which is the construction budget. We double it. Okay. But more seriously, we have a long checklist of having done this so many times. We have a long checklist of the things to look for: bowing floors, joist work, structural issues with the basement. We can walk a property and pretty much instantly know what those issues are. But on top of that, we have structural engineers, we have property inspectors go in and look at those things, and we give them the list before they go to tick off the major things that are wrong with buildings from that era in that city, so that we know we need a budget for that work. And we have contractors in line to go and do that work. That said, if there's a very serious structural issue with the building, it's not going to be for us. If it's going to be a 70 to 80% of the dollars we spend is in the building and we're basically redeveloping it to get it to work, that's not going to be one of our deals. We want to be more focused on the aesthetic. But things like joists and beams and sistering and stuff like that is part of the trade. And we have no problem doing that. And it provides one more competitive advantage. When there's an obvious but slight structural problem, of the few buyers there are out there competing with us for these assets, it scares those ones away. So if we can effectively resolve those issues, it's just, better for us.
That's cool. I love it. On the aggregation side of things, let's talk exit. You aggregate these into a 150 unit portfolio, and then you move that off to private equity, institutional capital of some sort. Do you have to basically aggregate them all within a certain radius so that, the institutional capital is attracted to it? Or how do you do it such that they can achieve that economy of scale without saying, having a 30-minute drive, again, I'm gonna go back to Indianapolis, across Indianapolis, trying to get to all the different properties?
That's a great question. So the key here, and for institutional buyers, is thematic investment. So what they want to see is a similar, digestible, understandable type of asset. And they don't need to be in the same neighborhood, but they need to be in similar types of neighborhoods. So for us, we've picked MSAs and cities that are all similar to each other. And I'll talk about what that means and what we look for in a market. But we are all within 10-minute drive time to the downtown or major job center area. we are in the most core submarkets in each city. So you can think the 5 or 6 neighborhoods that somebody would say, oh, I live here. And then you go, oh, I know that. That's a really cool place to live. My younger cousin lives there. She's 28 and she is a lawyer or whatever. And that's the area that we are targeted in each of these markets. But across markets, what we are working on and what we're specifically targeting are recession-resistant markets in the Midwest that have really key fundamental factors for us. So they have strong affordability. They're below the 25% AMI line. They have strong mid-single-digit population growth. Their population growth is over-indexed in super sticky job markets like healthcare and education and medium-cost location business services and technology jobs. So in a recession environment, they're sort of the last to be fired type of people. So really strong fundamental markets. And then the other thing that's really important to us is that they prove themselves in our most recent financial crisis. So we go back and look at the multifamily price per square foot, price per unit, average trade volume for 2007, 2008, all the way to 2012. And what we want to see are markets that look flatline or slightly up while the rest of the United States is crashing. And there is very recent data to look at how markets react in a recessionary environment or a crisis. So why not go and look at that information and figure out which ones do well and which ones don't? And these are the markets ultimately that are the highest performing. We have 7 or 8 MSAs that are on our target list to add in the near future, but Pittsburgh, PA, Columbus, Ohio, and Cincinnati, Ohio, sort of the same MSA, and Indianapolis, Indiana, those are the 3 that we're hyper focused on right now, perform best on those metrics. And when we exit, there's a theme. They're very similar sizes. They have very similar employment bases, similar fundamental real estate economic drivers, and they perform similar in downturns. So we have that recession resistant protection, and institutional buyers want to see that on the back end.
Yeah, and I think to your point you made early on, you're able to provide a best-in-class product for less than maybe even potentially what your competition is providing. So yet further insulating yourself in a potential recession. People are going to, if you're already giving them incredible value and a place to stay and live, it's unlikely that you're going to see, any tenant flight. I've got one last question for you on this. I would imagine lending side was a complex thing for you guys to figure out. How do you guys handle that? With this many closes, this many properties, going back in, I'm guessing, I'm just projecting here. So tell me if I'm right, then maybe it is. But I would imagine it'd be kind of a nightmare getting an individual loan on each property. How do you guys?
You're spot on. That's one of the most difficult parts of the process. Overall in real estate, lending and title are the most archaic and difficult things to work on, and they're the most difficult things to systematize and do at scale and do rapidly. But what we've done is very slowly and steadily built strong relationships with specific lenders that do construction style lending, because that's how we usually enter an asset or a group of assets, is with a construction style loan where they'll finance a lot of the closing costs, but then they'll finance the entirety of the renovation. Once we've completed that process, we'll refinance usually on a mini portfolio level across properties. We never do cross collateralizations, but we'll do 25, 30-year AMs in a program with a bank so we can get the best rates and the best amort schedules there. But at entry, which is the most difficult and time-harried part of the process, because sellers want to close as fast as they can, we built these relationships with them. We turn them into lines of credit instead of individual loans. Right. So what we do is we have a sponsor level approval where they've done background checks on us. We've had full exit turnarounds with them many, many times, and they feel comfortable putting us in a program where we can very quickly come to close. And in some cases, we even have an abbreviated appraisal process where it's very quick. They actually use our underwriting for the appraisal parameter. And once that's done, it can be from 2 weeks, we let them know, to closing, we've got financing at close. So it's really been that, but it's a complicated problem, right? Some lenders only do 2 to 4, some only do 5+, some don't do Columbus, but they do New York, et cetera, et cetera. The list goes on. And so we've got a list of really 8 lenders that we have close relationships with. And that's the only way that we can operate at scale across the different asset types and regions that we do.
Yeah, that was going to be kind of my suspicion on that, was that it was going to operate more on the line of credit sort of, so you guys could continue to buy and buy quick. I know there's nuance to it outside of that, but that's absolutely fast. Ray, I've learned a ton from you today. I love the market you're in. It's very unique. I love the way you guys are taking down assets, the strategy behind acquisition to renovation, the type of tenants you put in, the cool stuff you're doing in those communities, because those are buildings. I know that type of building very well, and those are buildings that need companies like you coming into these MSAs and turning those around and bringing them back to assets for the city and not just old rundown buildings. So I absolutely love what you guys are doing, and you're getting rewarded for it, which I think is the final piece of the equation that makes this all go around. So very, very cool stuff. If our listeners want to get in touch with you, learn more about you, or invest with you, what's the best way to do that?
Yeah, so the best way to do it is to visit us on our website at usaterra.com. There's actually some cool case studies, including 3D modeling of some of the renovations we've completed that you can check out on there. They're fun to walk through. We're also on LinkedIn, which is where we post a lot of our thought pieces and articles that we're thinking about and working on. And also feel free to email us at info@usaterra.com. And we'd love to pick up the conversation and go from there. We always say that there's nothing we love more than talking about multifamily real estate all day, as nerdy as that sounds. But it is true. And we're actually working on our third capital raise right now. It is on those same markets, Pittsburgh, Columbus, and Indianapolis, and the exact same strategy where we're doing 2.1, 2.4x net return on capital for our investors. And we are wrapping that raise up over the next 2 or 3 months. We just launched at the beginning of the year. We're about halfway there, but would welcome folks to join on and hopefully be a part of the Terra process for the next 15 plus years. We're doing another fundraise a year from now, and we'll, keep going on the same mission and same strategy. There's a very, very long runway for what we do in the U.S.
That's awesome. That's usaterra.com. For those of you who are listening, Ray, thank you again for coming on the show today. I certainly appreciate it.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.